Hey all, good morning and welcome to ShareTreck. This is Raj here, and this is our Saturday edition. A lot of interesting things to talk about, so let's get started. Hey all, welcome back. We had a great week so far. In the genomic sector, stocks like PACV and DNA that were languishing sprang back to life and made great gains. Allogene and CRISPR both seem to be on a strong bull run, and Bluebird is still riding high in anticipation of Beticel approval this month and Elicel approval next month. So a lot of interesting things happening, and some of us who have genomic shares in our portfolio have seen a little bit of green creeping into it, and it's a good feeling to have. So let us savor this. The markets are buoyant because the CPI data showed that inflation had plateaued last month, and the anticipation that the food and other downstream prices will also start dropping as a result of the 7% drop in fuel prices last month is adding to this optimism. In the field of project management, which is where I used to work before, there is a saying that while planning a project, when we make an assumption, there is a risk, and mitigation has to be planned in the event that the assumption does not materialize. So our assumption here is that the inflation, which dropped in the fuel prices at 7% last month, is going to percolate into rest of the economy, and other prices will start going down. So now let us examine the market in this light and see what is our risk exposure out here. All of the indices have broken out of the bear channel and can still turn back in the event of any disappointment or new negative stimulus. What could those be? These are the main questions that we have. I've listed just 4 of the potential negative and positive stimulus that could possibly happen in the next near future. The first one is that the Russia-Ukraine crisis ends, which will be positive. But if Russia uses any nuclear or chemical weapons, that would be negative. Anything could happen. We don't control the world, and no one can predict what is likely to happen. If China attacks Taiwan, that would be a big negative and instantly cause chip shortage and chip inflation. So that could ruin everything in the EV and technology sector overall. And the midterm election will bring volatility. The result of the midterm election can boost or curb the stock market. So midterm elections being in November, the run up to the midterm election is going to show us a bit of volatility, and the result of that will influence the market for the remaining month of the year. And finally, next month we may hear inflation report that says fuel prices are low, but food and other prices have not fallen. This is one possibility because of price gouging or whatever it may be. So in the event that it happens to materialize, then we would have a problem. So these are just 4 top of the mind risks that I have identified. If you sit with a paper and pencil and do some brainstorming, you can come up with more. Therefore, it is most likely that the Fed will remain less hawkish in their statements, but may still continue the stealth balance sheet tightening that we do not focus on. That could take away a lot of liquidity from the market. More about this later. And the Fed needs to do this because in the event any of those risks materialize and the market starts dropping, and when the economy goes negative, then the Fed will need to have room in the interest rates in order to boost the market again. And that's the reason why the Fed will be in a bit of a hurry to raise the interest rates. The Fed, I think, will also continue with its 75 basis point hikes without making hawkish statements. This is the most likely scenario. Now let us look at how much liquidity has been taken out of the market. When COVID hit, there were lockdowns and the economy was grinding to a halt. To rescue the economy, QE was reintroduced, that is quantitative easing. The goals of quantitative easing were to reduce long-term interest rates and provide additional liquidity to the financial system. QE reduced long-term interest rates by driving down yields on the securities the Fed was purchasing, which led to lower interest rates throughout the economy. And that was really good for the stock markets, and everybody was taking a lot of risk. And it was excellent for the genomic sector because a lot of funds were flowing into risky genomic stocks, startups. The reduction in yields on MBS translated to lower mortgage rates, stimulating housing demand, and house prices started rising. QE increased liquidity by increasing bank reserves. When we encountered a tight labor market and rising inflation with the economy overheating, in November 2021, in response to that high inflation, the Fed announced that it would taper off its asset purchases by purchasing fewer assets per month. In March 2022, it ended the asset purchases, at which point the balance sheet had more than doubled from its pre-pandemic size. In June 2022, it began to shrink its balance sheet. That was just a month ago, popularly called quantitative tightening, by allowing initially up to 30 billion of treasury securities and 17.5 billion of mortgage-backed securities to roll off the balance sheet each month for the foreseeable future. So that takes out almost 47.5 billion per month from the market liquidity. And the balance sheet is not expected to return to its pre-pandemic size. However, when taken together, the reduction in liquidity and the progressive interest rate hikes should do the trick. That being the most likely scenario, we should expect the market to roll back gains closer to the next inflation reading, because the current euphoria will die down and people will visualize the risk that the Fed may be dovish, but its actions are likely to be hawkish. And when that happens, the markets will start tapering down, it will consolidate and move downwards. And now let us look at the global scene. The UK is in a bad place with its GDP contracting 0.1%, which is still a disappointment despite it contracting less than the expected 0.3%. Real income in UK is dropping and is likely to be the top priority for the next Prime Minister. Boris Johnson has left a dog's breakfast mess behind him, and whoever succeeds him will have multiple high priority problems to handle. The Brexit status quo left behind by Boris Johnson is worse than what he got when he took office. The current arrangement strains the Northern Ireland peace agreement, as this causes the need of a formal border between Republic of Ireland, which is in EU, and the Northern Ireland that is now out of EU. This problem has to be resolved very quickly. Also, the result of Brexit is the snapping of established trade ties and labor flows in the backdrop of the global economic crisis. The next PM does indeed have a bunch of major challenges in hand that has to be tackled immediately. Earlier, we had news that EU had grown 0.7% despite the gas crisis. We should expect the next quarter will see EU not doing as well, because the gas crisis would have broken through the economic defenses and started showing up more starkly in shrinking GDP. China has anemic growth and it's handling a multiple economic crisis and geopolitical problems just like Russia. To conclude, I think we should enjoy the current market rally while we can. I personally would put a covered call wherever it makes sense, so that I can reduce my cost of ownership if the market were to fall. The markets always move up and down, and in a bull market, it creates a series of higher lows, whereas in a bear market, it creates a series of lower lows. This means the prices can fall again before rising further. One of the tools available to us for that eventuality is the covered call. We need to remember a political crisis is brewing in the US. While Trump and his supporters in Congress and media decried the FBI search of his home, we saw an individual armed with weapons head into an FBI office. The result of the action was not good. It was reported later that after an exchange of fire, the individual is now dead. It appears that politics in USA is rapidly degenerating, and as investors, we need to add a risk premium to US-based companies, because if rule of law collapses, then companies cannot have reliable agreements and terms of engagement to conduct business and rightfully make profits. For a significant period of time, the spin in the media is likely to make us not look in this direction. But if we were to look at any other country like China, for example, the risk premium is already in because the government is unpredictable. And if you look at other countries like Nigeria or any other place where we have oil interests and the government is not stable, there is a big risk premium added to that. And the same is likely to be evaluated by rating agencies when the rating cycles come in. Therefore, we have to be a bit vigilant, and we have to hope that sooner rather than later, the Department of Justice manages to put a muzzle on all these destabilizing forces and give a good chance for all these great companies that we are investing in to have a level playing field and a predictable terms of engagement, so that we can continue to make profits and society in general can have progress, and those who are in the working class can continue to do their 9-to-5 job and enjoy a good quality of life and work towards improving their status in the economy. With that said, I would like to bring this video to an end. I hope you have a wonderful weekend. And if you like this video, please press a like out there. And if you're not yet subscribed, why not? Please subscribe and help us grow this channel. We'll have a lot of articles out here regarding genomics, shares, macroeconomics, geopolitics, and generally thought-provoking ideas. And I would like to hear from you about your reaction to this video. Put your points of view on these things and something that I might have missed out in the comments below, and let's have a dialogue. Thanks and have a great day. Bye for now.